Okay, good evening. My name is Gary Harris. I'm a wealth manager here with Paragon Capital Management. Before we get started, I have a few housekeeping items. The chat has been turned off as to not to distract from the presentation. The Q&A may only be available on a desktop or a laptop. So if you're using an iPhone or an iPad and you do not have a Q&A button, you can email questions to gharris@paragoncap.com. That's GHARRIS at paragoncap.com. And please take a moment to listen to this important compliance message. The views and opinions expressed in this presentation are those of the speaker and do not necessarily reflect the views of any affiliated organization or institution. This presentation is intended for informational and educational purposes only and should not be construed as investment advice, a solicitation, or an offer to buy or sell any securities or financial instruments. All information discussed is based on publicly available data and resources believed to be reliable, but no representation or warranty, express or implied, is made as to its accuracy or completeness. Past performance is no indication of future results. Attendees should consult their own financial, legal, or tax advisors before making any investment decisions. Now I'd like to turn it over to Craig Navor, the owner and chief investment officer of Paragon Capital Management. Craig?
Thank you, Gary. And I appreciate everybody that's taken some time to spend their evening with us tonight. This is our second town hall we've done today. We did one this afternoon that was well attended, and I appreciate those of you who prefer to have this evening presentation. We want to try to make these convenient for whatever works into your calendar. This presentation was originally designed mostly for new prospects to Paragon, but we've got quite a few current clients on there as well. So you might hear some things that you already know, and you might learn a few things that you don't. So we are glad that you're able to join us. Please submit some questions. We'll have some time at the end, and it's a lot more fun when we can hear what you're thinking and not just listen to me ramble for an hour. Kind of kicking off here, let me share my screen. Here we go. So welcome. So our agenda today, kind of give you an idea what we're going to talk about, a little welcome and intro to Paragon Capital Management, an overview of our investment strategies and financial planning services. A lot of people that are current clients of ours may only utilize one or two of our strategies. And so we'll let you know kind of everything that we do offer. How do we determine what to recommend to clients? We're in touch base on our alternative income strategies, so mostly structured notes, but happy to answer any questions on private credit. Basically, what are structured notes, how do they work, and why it's a good time to invest in them. We're going to talk some tax advantage strategies. These are great for business owners that are looking to sell their businesses or anybody that has a large capital gain upcoming, and anybody that has a large concentrated stock positions are looking at diversifying without paying taxes. Those are things like long shorts and charitable giving techniques. We're also going to do a few slides on the market and the economy, and then leave room for questions in the end. For those who are not current clients of Paragon, Paragon was founded in 1998 by Howard Jacobson. So we're approaching our 30th anniversary, so we're very excited about that. I joined Paragon in 2006, so it's been 20 years for me at the helm of Paragon. We appreciate all of the clients that are on here for your support of Paragon over the years. We do custody our assets at Charles Schwab. That is very important. Paragon is a power of attorney that manages the client's assets. We are an independent registered investment advisory firm. Your assets remain at Charles Schwab, and you can access through those assets through Charles Schwab's app or through their website. All we do is have the power of attorney to trade the assets in that account for you. We do typically manage money for individuals, mostly high net worth and ultra high net worth. Where we define that is we start with $500,000 of investable assets as our minimum to be a client. Our ultra high net worth are typically our clients that are qualified purchasers, which means they have access to things like private credit and other investments like our long short strategies that could have minimums in the $3 to $5 million range per investment. We also manage money for other registered investment advisors across the country. So we are a separate account manager for those, mostly in the structured note side of the business. For those financial planners and investment firms that want to offer structured notes but don't want to do it in-house, they contract with us to create the structured notes for their clients. If you are not familiar, we have a lot of information on our website, which is paragoncap.com. And we also have about 25 videos on our YouTube channel, including videos on all the structured notes and videos with our founder, Howard Jacobson, which some great videos about his time in the markets going back to the 1960s, why he started Paragon, some of the great stories he's heard over the time, and also on some different investment topics and strategies. So we encourage you to check out the YouTube page and check out some of those videos. This is a pretty extensive list of everything we do. We are a full service wealth management firm. So we do manage going back to our beginning in 1998 and going back to Howard and my time at our previous employer, run an individual stock portfolio of about 25 stocks. We also manage both taxable and tax deferred or tax-free municipal bond portfolios, creating ladders of bonds for our clients that are interested in those strategies. We also are known nationally for our structured products, which include both growth and callable yield notes, as long as our new Catapult notes, which we'll discuss here in a minute. We also offer private equity. We have access to just about any private equity fund that you can think of, as well as private credit and private real estate. We are offering tax advantage strategies, i.e. long short, direct indexing. We'll kind of explain the difference in those. Long short have been in the news recently a lot. We have some clients already utilizing it, and it's a great strategy if you are selling a business or selling an asset with a large capital gain, or plan to sell an asset with a large capital gain, or have a stock, individual stock, or a stock portfolio with a lot of capital gains. The long short strategy is a great way to be able to unwind that with getting market returns and being able to offset the gains. We also have access to hedge funds, 1031 exchange options, charitable giving options such as donor advised funds, charitable remainder trusts, and qualified charitable donations, as well as a great financial planning team headed up by Gene Powell and Brady Hogan, of which they have recently added some software that allows us to do some tax planning as well, where they can upload your tax returns and do some analysis of your taxes through that software. So we encourage you, if you're not utilizing our planning services, to check that out as well. I am going to now switch over to my tablet, which, if any of you know me, I love to doodle on my tablet, and we're going to talk a little bit about structured products. So structured products is something that Paragon got into around 2014. So we've been doing it for about 12 years. We've originated somewhere between $1.5 and $1.6 billion in new notes for our clients. Structured products are something that's been around since the 1980s. They have had a lot of negative connotations around them throughout most of their life cycle due to some wirehouse brokers that have treated them to their advantage and not their clients' advantages. If you were to Google structured products or structured notes, you'll find a couple 100,000 articles on the internet, most of them fairly negative, most of them very accurate for what they're reporting, which is high fees, big front loads, risky asset classes, capped returns, things that are not in the client's favor. At Paragon, we are able to create our own notes, control all the terms, take out all the bad things, and just leave behind the good parts. We offer both growth notes, our traditional notes, and our new Catapult notes, and our most popular right now are income notes. Structured products are offered by about 19 to 20 banks. We have direct relationships with all those. They're banks such as Goldman Sachs, Citigroup, Bank of America, Morgan Stanley, Bank of Montreal, Toronto Dominion, CIBC, Barclays, UBS, BBVA in Spain. We've got Crédit Agricole and Natixis, both out of France. You've got Nomura out of Japan, HSBC. So, a lot of different banks in there. I'm sure I'm missing one or two in there, but, really the biggest banks in their respective countries that issue these as senior unsecured debt of the bank. So what does that mean? A typical debt structure would start with something like common stocks, then preferred stocks, corporate bonds, junior debt, then senior unsecured debt, and then senior secured. Senior secured is going to be like your private credit. Senior unsecured, second highest form of debt a bank can offer. That's going to be where we're playing with the structured note schedule. When we're looking at investments, these are underlier is a zero coupon bond. And as I explained on our earlier call, when you're looking at any kind of investment, whether stocks or bonds, there's a fundamental case to how you value those investments. With equities like stocks, there is no one way to value a stock. Every investment manager that you talk to can value it in a different way. Some might value price to earnings, and we'll talk about some price to earnings later in the slideshow. Some might do price to book or price to sales. Some stocks don't have any earnings at all, so you may have to look at those from a momentum standpoint or same store sales standpoint or growth rate or whatever the metric is that you prefer. With bonds, though, every bond manager value bonds the same way. And the way you value a bond is you figure out the income you're going to earn on that bond until it matures, and then you bring it back to its present value. With a zero coupon bond, that means it's not paying any income, which means it has no value. So you buy it at a discount. And so you might buy it for 90 cents on the dollar. And that 90 cents on the dollar would be considered tier 2 capital or a deposit for a bank. And the banks are very eager to get deposits because when interest rates went higher, most investors, both institutional and retail, took their money out of banks and bought money market funds, which are not considered deposits. And they need deposits to be able to lend at higher interest rates and make that net interest margin. The other 10% goes into an option strategy, which is how we're going to achieve the results we're going to talk about here. So starting out, we're not going to spend a lot of time on this because we only have an hour today. I don't want to get through a lot of topics, but just real quick, a growth note, just to kind of show you how structured notes work. These are what we've been doing the longest. Growth notes are typically 5 or 6 years until duration. We're doing it on what we call the worst of the S&P 500 and the Dow Jones Industrial Average. So big, broad base indexes. We have never done one on an individual stock or a sector or an industry. We're sticking to broad base indexes. We are putting downside protection under your investment. So let's say a 20% buffer. And we're going to those 19 banks and we're asking them to bid on what they'll give us if the market goes up. So let's just say 150%. So at maturity in 5 to 6 years, there's only 3 outcomes. Outcome number 1, the market is between 0 and negative 20. If that is the case, that means the stock market is down for a 6-year period and you are going to get all your money back. So you didn't lose anything when the market is down 10, 15, 18%. If the market is down more than the buffer, let's say it's down 25%, you'd only be down 5% and you'd get 95% of your original money back, which would come back to you why the market is down 25%. So you'd be able to reinvest 95% of your money back, which means you're going to get positive a whole lot faster. If the market is up, which has been every case for us since we've done this, if the market's up 10%, you would multiply that by 1.5 and you'd be up 15%. If the market's up 50%, you'd be up 75%. If the market is up, this happened to me earlier as well. Hold on one second here. Let me get this reconnected. Last time I kept talking, I didn't realize it did that to me. So let me get this. All righty. Where is my mouse? My apologies there. All right. 50% would be 75, 100%, 150. And this is never capped. It just goes on and on and on. So the nicest part about this, if you're an investor that invests, let's say, in the S&P 500 index fund at Vanguard or at Schwab or somewhere, with an S&P 500 index fund, you get 1 times the return if it goes up, and you get 1 times the return if it goes down. With our product, you're getting 1.5 times if it goes up, and you only have a maximum of 0.8 if it goes down because you're 20% protected. So it's a better way to invest in the index because you get the downside protection, especially right now when the market's at an all-time high. Moving on to what we call income notes or callable yield notes. The good thing is I'm a better money manager than I am at handwriting. With the callable yield notes, these are going to be a maximum of 3 years. Sometimes they're 2, sometimes they're 3. And we're going to offer 2 different varieties. We're going to offer notes with 30% downside protection, and that's called a barrier. A little bit riskier, which is why we're doing 30% instead of 20. And a more conservative 45% barrier as well. This is going to be a combination of 3 indexes. We typically are doing the S&P 500 or the Dow Jones Industrial Average. We're typically doing the Russell 2000. And then on the 45% notes, we'll sometimes do the NASDAQ 100. And then we typically are doing the Euro Stoxx 50, which is the 50 largest stocks in Europe. Now, we've never really done any other indexes than those 5. So we're going to pick 3 of them, and we're going to do a worst of, let's just say, the S&P 500, Russell 2000, and the Euro Stoxx 50. These are going to pay income to you every 90 days. If that is in a taxable account, it is ordinary income. If it is in an IRA, it is qualified. So at the end of 90 days, I think it's losing me again here for some reason. All right. At the end of 90 days, technology. Give me 1 second here. I apologize. I only did that once to me this afternoon, so I don't know what's going on here. All right, back at it here. At the end of 90 days, if all 3 indexes are higher than the barrier, you get paid your income. This week, we did a note at 12.9%, and that was invested at par, which is face value, and a 45% note. I don't remember exactly what it was, but it was over 10%. We've been, for the most part, over 13% most of the year. The more volatility in the markets, and we'll talk about the VIX later, but the more volatility, the higher the interest rate. So what they're doing is they're putting 90% of that money on their books as Tier 2 capital. Then they're selling puts in the open market. Somebody's paying a premium for those puts, and that is being passed on to you as income. If any of those indexes are down, then you would not get paid. And since 2014, we've had one $750,000 note miss one income payment ever. and that ended up still paying 9% for the year. So still a great deal. But we did miss one coupon, so it does happen, but does not happen very often. If all three indexes are higher than the day we bought it, they can call the note. You get all your money back plus your coupon payment, and then we will automatically roll that into a new note for you. For the most part this year, we have been reinvesting at higher rates, which has been great. That is not always the case. Sometimes it's slightly lower. That's why we are going to typically buy you a minimum of 4 notes and spread that out with hopefully different banks, different maturity dates, different coupon payment dates to build you a ladder to spread out that risk so that if one does get called and gets reinvested at a lower amount, that is only one portion of your portfolio, not your entire portfolio. And usually if it is down or up, it's down or up very, very little. It's never a big move because these things don't move that much. So that's a callable yield note. At maturity, there is the risk with this one that if the market, and very few of these ever actually make it to maturity because the stock market keeps hitting new highs. But if over a 3-year period at the maturity, the market is down more than that barrier, the barrier goes away. So if it's down 31%, you could be exposed to a 31% loss. However, we do manage this portfolio for you. So let's just say you invested $1 million. Let's just say we average 12%. And we put you in, let's just say 5 notes at $200,000 a note. That would generate about $120,000 a year of income times 3 years if it doesn't get called. So it's $360,000 of income. Let's say at maturity, one of these notes, the market just takes a dive. And even during COVID, it was only down 30%. But let's just say one of these takes a dive 50%, just to be extreme. So you lose $100,000 of your principal. You still made $260,000 over 3 years, which is still over 9% a year. So still turns out to be a pretty good investment. However, the likelihood that we're going to let that go to maturity is very low because we do watch these. And so we did have an example back in 2022 where we had a note that was down 31%, or was actually down 32% with 5 weeks until maturity. We priced selling it. We could have sold it for 94 cents on the dollar, taking a 6% loss versus risking a 32% loss. We decided to hold on to it and watch it. And with 5 days till maturity, we were able to sell it at 101.5, which is a 1.5% profit. We did give up that quarter's coupon of about 2.97, but we did not lose 30-something%. We were able to protect the portfolio and make sure that we got all the principal back, which was the key. And so we do watch these things very closely, and we will protect them if we do see a market downturn. The final note that we did, and we started this one a little bit over a year ago because we were generating so much income for some people that they wanted a more tax efficient strategy, but they didn't want to lock their money up for 6 years. These are called catapults. Why they're called catapults, I don't know, but they're called catapults. So what we're doing is we're going out 12 months and usually about a day, depending on if it's where the weekend falls. We're going to do this on 3 indexes like the S&P, Russell, and Euro Stoxx 50. Again, typically avoid the NASDAQ on this. And at the end of 12 months and a day, if all 3 of those indexes are not down more than 10%, they will call the note. And our last note was 20.3%, which is taxed as a long-term capital gain because it's over 12 months. So you get all your money back plus over 20% return. We've been pretty consistently on the low end. It's about 16%. We've been pretty consistently in the 19 to 20% range since we started doing these. They've been fantastic investments. We've had several of them already get called and clients get their money back. If the market is down more than 10% after a year, you do not get the payment. They add 2 years. So now it matures at the end of year 3. You have your 30% downside protection in the form of a barrier. And you get 150% upside, just like the growth note. So if the market's up 10%, you'd get 15. If the market's up 50%, you'd get 75. And so it just turns it into a 3-year growth note, which we think is better than having a 6-year growth note and tax that long-term capital gain. Happy to answer any questions about those. I'm going to jump back to our slideshow in the interest of time, and we're going to move on to long and short strategies. So this is something that is a really kind of a big deal in the industry. There were so many of these done in the last couple of years that Fidelity has shut the door on them for now and said, we need to take a pause and not accept any more clients with a long short. Charles Schwab just started allowing them May of 2025, so they've only been in the business for a little bit over the year. They are still doing them, but they have cut off some of the more risky profiles and are just allowing some of the less risky profiles, which we'll talk about here. So with the long short strategy, what we're doing is, and there are about 4 or 5 firms that do this. I'm just using AQR as an example, but we do have different firms that are available. So if you invested in just an equity ETF like the Russell 1000 or Russell 3000, it goes up, you go up, it goes down, you go down. With direct indexing, which has been around for a long time, they do the same thing, except they're constantly selling the losses. So maybe they sell Coke and they buy Pepsi, or they sell Home Depot and they buy Lowe's. So they're locking in losses throughout the year, trying to generate as many losses as possible to help offset gains and other things. Direct indexing is a great strategy, but if the market continues to go up, eventually you run out of losses and the portfolio gets kind of stale. With the long short strategy, you are now introducing margin and borrowing money. Sorry about that. Very sensitive. And borrowing money. So you never run out of losses because you are both going long the market and short the market at the same time. So if you were good, you could fund this with an existing stock or with an entire portfolio of stocks or with cash. So let's just say you put $1 million, let's just say you put $1 million of stock into it, and we picked Russell 3000 or the Russell 1000 as our goal. Your return should be better than what you would have gotten if you were just in an index fund. However, you could be as much as 200% long the market and 100% short at the same time, which is how you end up 100% of your return. So you're going to generate a lot more losses with this strategy than you would with direct indexing. They offer, most of them, and every firm's a little different on what they offer. This particular firm offers 145% long, 45% short, 200% long, 100% short, 250% long, 150% short, 300% long, 200% short. Now, Schwab has recently cut off the 250 and the 3, so we cannot put new clients into that. So most we can do is offer the 145 and the 200. You can see the tracking error is substantially more for the 200, but your return is going to be a little bit greater if everything goes correct. So in a hypothetical pre-tax return, if the Russell 3000 was up 7.6, the Flex 145 should return slightly better than that, and the 200 should be significantly better than that. And so it's a really nice strategy. We are doing this for a client, for example, that came to us. He was selling a business. His CPA suggested he sell the business December 31st. That way he doesn't have to file tax returns again in the next calendar year. I suggested the Flex 300 because it was still available, and that he closes the sale of the business after the first of the year. We ended up getting the account funded in April, so it's now been 3 months. He funded it with $4 million. And this is a real client. These are real returns. Right now, at the end of June, 3 months in, his account is worth just under 4.2 million. So just under $200,000 in real gains. And we have realized losses of over $1 million in 3 months. So at the pace of $1 million every 3 months, he would be on pace to lock in $3 million in realized losses that he can use to offset the gain that he made in his business, which will save him, 600,000 or more in taxes. So this is a great strategy. You can also do it with an individual stock. Let's say you funded it with, let's say, Nvidia or Apple. As you take those losses, i.e. the $1 million in losses, you are selling the stock and offsetting it dollar for dollar, so you get out of that appreciated stock position without paying any capital gains taxes. So it's great for a sale of an asset. It's great for a concentrated stock position. It's great for if you had a direct indexing product that you bought several years ago and you've run out of losses, but now you have a big gain in that. You could transfer that into a long short to get out of the direct index, or just to create a better core equity portfolio. Happy to discuss this one-on-one with anybody that wants more information. The negative part is the 145.45 does have a $1 million minimum per Schwab, and the Flex 200 has a $3 million minimum per Schwab. And so those minimums are much higher and not suitable for everybody. Moving on to charitable giving. Charitable giving is something that Paragon is very big on. We offer different ways of doing it, but the most popular are things like donor advised funds. So with the tax law changes several years ago, if you don't donate enough money, you cannot take a tax deduction. So what you can do is you can bundle several years worth of donations together into one particular year, put that into a donor advised fund, and take a tax write-off in the current year, and then give that money away throughout your lifetime however you want. So again, a real life example from a real client we spoke to. This couple was giving $25,000 a year away between their church and other charitable 503Cs, and they were not getting a tax benefit for it. Over the next 10 years, they would have given away $250,000. So what we did was we took $250,000 of appreciated stock, we donated it to a donor advised fund. They were able to get out of the capital gains on the stock because we donated it. They were able to take a $250,000 tax donation on their tax returns. We were able to invest the $250,000 in callable yield notes, which are now at 12.9%, which means they're making way more than $25,000 of income. They're able to give away the $25,000 a year that they want. Their $250,000 continues to grow, and after 10 years, instead of having given away $250,000 of their hard-earned money, they will have more than $250,000 in their donor advised fund. They will have given away $250,000 over the years, but still have that principal, which will continue to generate income. So it's an amazing tax strategy to be able to use, to be able to get out of capital gains, and to be able to invest it, generate income, which you can then donate. You can donate the principal as well, but in our example, we were just donating the income off of it. We also were talking about qualified charitable donations. So if you are over 73 years old and you have a required minimum distribution from your IRA, that that required minimum distribution becomes ordinary income on your tax return. Some people don't need that, and so they would rather donate money directly from their IRA to a charity, and then they get out of the income tax. And so you can fulfill your required minimum distribution or just reduce your IRA by making donations directly from it. So a lot of great strategies. We have a lot of knowledge in this area and are happy to discuss those with you, as is our financial planning team, Gene and Brady. That kind of concludes what we do. Wanted to touch base a little bit on the market and the economy. I'm not going to get too deep in the woods here, but very sensitive here. All right, there we go. So year to date, the stock market's up, not including today. This is through June 29th. The market's up 7.4%. Obviously, if you annualize that out, you're looking at about 15% year, which is incredible considering the couple of years that we've come off of. This chart shows about a 10-year history where the S&P 500 has gone from about 2,000 to almost 7,000. It's been an incredible run, but as you will notice, the market does not go straight up. It has had a lot of deep sell-offs, including about 32% for COVID. It had negative 18% in 2022 for inflation. We saw a big drop of almost $5 trillion the day the tariffs were announced in 2025. And so you have seen these big drops in the market, including the one this past first quarter with the war in Iran. But the market always snaps back and always has snapped back throughout the history of the market. The market goes up 2/3 of the time. It goes down about 1/3 of the time. But those downdrafts create a lot of volatility, which is great for us for buying structured notes or even for people that are buying individual stocks to give you a buying opportunity. So we look at that chart and we see opportunity. And we also see a little bit of risk with valuation. So when we look at the valuation, right now, the price to earnings ratio on the market is around 20.3 times, which is much higher than the historical average of 16, but below several recent highs, which were in the 20s, including almost 25 times back during the tech bubble in 99-2000. But we did get it back up into the 22-23 range back after COVID and back in 2025. And we have seen it come down a little bit, but we still think the market is expensive. We still think there's risk in individual stock names right now with some evaluations of those. And we've seen technology stocks, again, similar to 1999-2000. We've seen technology stocks become about 30% of the S&P 500. And it's a big if, but if SpaceX, Anthropic, and OpenAI all were to join the S&P 500 when they go public, you could see the top 10 names in the S&P 500 make up as much as 50% of the index, which that is obviously something that concerns me. For those of you who do not know, I had the great fortune of launching a technology fund on May 1st of 2000, right about the highest point you could find on this chart. So valuation does matter. Looking at interest rates, we did talk about our structured products making around 10% on the more conservative notes and 12.9% on the 30% downside notes. The 10-year treasury right now is at 4.38%, and the 2 years at 4.07. Inflation is over 4%. I'll show you that in a minute. But that means that if you're earning a little over 4% and inflation is a little bit over 4%, you have no real return on your money that's in the bond portion of your portfolio. And most advisors don't have a solution for that. And so the structured notes is just a great way, or even private credit, to be able to get double-digit type of income to offset the inflation. You guys have all heard the term treasury yield curves. The reason I included this slide in this deck is 1 year ago, we had an inverted yield curve. A lot of people hear that term, they don't know what it means. It's always been historically a trigger for a recession, although it never caused a recession during this inversion. But an inverted yield curve is when the 2-year treasury, depicted here with the red line, is higher than the 10-year treasury. we are back to a traditional yield curve where the 10-year is higher than the 2-year, which is much healthier than where we were a year ago. So want to just kind of point that out to you. This is a chart of inflation as depicted by the CPI, and we are at 4.2%, which again, as we talked about, that's not great if your bond portfolio is making you 4.38. I threw this in here. Years ago, they decided to change the term junk bond to high yield to make it sound better. A high yield bond is typically something that would be double B or lower. And right now on high yield bonds, you're getting about 7%. So these are riskier bonds because they're not investment grade. These are typically issued by corporations, and you're getting 7% to take a riskier bond where we're getting 12.9 on a senior unsecured debt of Goldman Sachs or Bank of America or Barclays or UBS that is fully guaranteed as long as they don't file bankruptcy. For me, I'd rather have the callable yield note than buy a non-investment grade bond for 7%. I wanted to throw this in here, and I'm happy to answer any questions at the end on AI, but I don't have a lot of slides on AI right now. We do have a fantastic summer intern this summer, and some young associates that are super bright. So I have them working on an AI project. They did send out an AI survey. So if any of our clients are on the call, if you took that, we greatly appreciate it. If you did not take that and still want to, we would love to hear your feedback. But we're going to hold another call like this, probably in the afternoon, later this month on AI. And it's going to be taking everything they learned this summer and just answering and explaining AI, kind of AI for dummies. You know, what's the difference in ChatGPT, Copilot, Gemini, Claude? What's a token? What's an AI agent? So all those things, the terms that you are hearing, we'll talk about that in another session, and we're going to let those guys lead that, which will be super exciting. But we do hear a lot of clients that do talk about, and they see the headlines of Meta laid off 30,000 people, or Microsoft's laying off people, or Wall Street's laying off people because of AI, and that is absolutely true. But when you look at the unemployment numbers, they're near historic lows. And so even though people are losing their job to AI, other jobs are being created. The difference in these two lines is the darker line is the actual unemployment. The gold line is underemployment. So underemployment refers to people that have a job, but they're not earning their potential. So maybe they're an engineer, but they took a job at Home Depot, while they're looking for a job. So the underemployed is an important number, because that's the percentage of people that are looking for a better job and just can't find one. But even that is at historic lows. And so AI has not been the cause of mass unemployment or a weak economy. I mentioned the VIX earlier. This is the volatility. Higher VIX is very, very good for us in pricing structured notes. Right now we're over 18 on the VIX. We've been as low as around 12 back a couple of years ago. And if you look at when the tariff was announced back in April of last year, or May, whenever it was, I think it was April of last year, it spiked to 52. And we did some callable yield notes that day and locked in over 19%. So right now, with the VIX at 18, we were getting around 13%. When the VIX spiked up to over 50, we were able to lock in on the exact same note with the exact same carriers, close to 20%. So we do try to take advantage of the volatility and lock in some really great terms for our clients. I wanted to show this chart. Many of you probably have never seen anything like this before. It shows the down draws in the market. But what I'm really wanting to point out, the red dotted line is that 20% down mark, which we have on our growth notes. But if you kind of think about where 30% would be, the only time we would really have seen a 30%, a 30% drawdown was a financial crisis in 0809, the tech bubble in 2000, which was 26 years ago. And so really, we have not seen a 30% downturn in the market in quite some time. And you very, very, very rarely go past the tech bubble. You have 1987, Black Monday, and then you got to go all the way back to the 70s. So the 30% down draw to us is very, very safe. You go to 45% down draw, that's even, happens less frequently. So these are kind of what we look at when we decide on that downside protection. I wanted to make a couple comments because we just talked about how the stock market's at an all-time high. And so the stock market is doing very, very, very well, but people are not saving money. And that is a problem. And that is something that does concern us. The US savings rate is at an all-time low. And so you're on this call, which means that you're an investor and you're a saver. So congratulations. But a lot of people are not. And that's going to be a problem down the road, especially if things like Social Security runs out and nobody has any savings. It's creating some big problems down the road that we are concerned about. We don't want to dwell on the war in Iran. I'm happy to answer any questions that you have about it. But one of the things we do know is that oil spiked to over $100 a barrel. Gas spiked to over $4 a gallon. We're still at $3.91 on average in the country. This is something that's obviously hurting personal savings rates because people are spending more money on things like gas and food. And that's also why the core of the CPI was up over 4%. If we do eventually see a peace deal in the Middle East, which hopefully we will, I'm not super positive we're going to see it anytime soon. But if we do end up seeing one at some point down the road, we should eventually see oil and gas come down, which would also help inflation come down. So kind of want to throw this in here. And finally, consumer sentiment, which is at an all-time low. And this is something that concerns me personally. It doesn't seem to be affecting the stock market, but people are very, very negative right now. And that is, at historic levels. And so, that is something that is definitely something we are watching and are concerned about. And that's kind of the end of my presentation. I've been chatting now for about 50 minutes, so I wanted to leave about 10 minutes for questions. I'll stay on as long as there are any questions out there. I will turn this over to Gary and see if anybody's got any questions.
Currently, Craig, there's no questions, but maybe we can answer for these folks one of the questions from earlier, which was, what impact would you see coming if the Democrats were to win the midterms for either the Senate or the House?
That's a great question. We did get that question earlier. And what I always talk about when it comes to politics is that the stock market can deal with good news and the stock market can deal with bad news. What it cannot do is deal with uncertainty. And so when you have all three parties in control, for example, the Republican controlling the House, the Senate, and the White House, the markets get nervous because tax laws can change, tariffs can be put in place, different things can happen that a CEO of a Fortune 500 company or a publicly traded company just cannot predict. So if you are ordering product from China and it's being brought over on a ship and it's not going to arrive for 3 months and you don't know what it's going to cost you when it gets in the United States, you may be tempted not to order it because it may come in at a price that you can't afford because you'll lose money on doing that. So if the Democrats were to win the House or the House and the Senate, what it's basically going to do is put a gridlock in Washington where nothing is going to get done. As many of you know, that's called a lame duck session. And so the last 2 years of the president's term would be considered a lame duck, which means he will not be able to get anything passed through, which is bad for his administration, but fantastic for the stock market. So the market should react very well to the Democrats winning the House if that were to happen. And then the other question that was asked earlier was our opinion on the new Federal Reserve Chair. And right now we just really don't have one. We've only heard him speak one time. So, we are anxious to kind of see the direction that he goes. But what I tell people when it comes to the Federal Reserve is that all the governors are the same. And even Jerome Powell, which is kind of historical because typically the outgoing Federal Reserve Chair does not stay on the Board of Governors. He has stayed on the Board of Governors. So the entire voting board is still there. We have a new chairman, but nothing else has really changed. Many people thought that because he was appointed by Donald Trump, and Donald Trump has been putting a lot of pressure on Jerome Powell to lower rates, that Warsh would feel the need to lower rates immediately. And he has made it through his first meeting and did not lower rates and even hinted at raising rates. So if he stays independent, I'm very, very optimistic that he's going to be a great Fed chairman and that things are going to be done that will be good for the economy, which would mean that we may see a rate increase this year. But I would anticipate some point in 2027 that we will start to see some rate cuts.
All right. Well, Craig, at this point, we don't have any questions coming in.
Well, hey, I just want to take a minute, and anytime you give us an hour of your evening away from your families or going out to dinner or whatever it is that we're taking you away from to spend time with us, we appreciate that. We also appreciate those of you that are current clients for joining us. And if there's any prospects on here, we appreciate you taking time to learn a little bit more about us. We think we have some interesting and unique strategies. If you know anybody else that would be interested in those, we would love to share them. We always love referrals. With that, we will sign off for tonight. Thank you for coming. Keep an eye and a lookout for our AI webinar that will be coming up. We'd love to have you join us for that as well. Thank you very much and have a great night.